Greetings, everybody. It's Jeff Scott. This is my weekend review for April 2nd, 2017. It is approximately 9:25 p.m. and right now the NASDAQ futures are up about 5, Dow futures up about 17, S&P about 1.5. So clearly one can say, since each of them are up less than 0.1%, that the market has not had any suggestion of what it's going to do yet tomorrow. Certainly flat compared to the close. I hope I'll remember to show you the close was kind of interesting. Perhaps it was some positioning at end of month. But all I know is I looked at my portfolio at 5 minutes before the end of the hour. I looked 5 minutes after, and there was a little bit of a drop. Still was a great week, but I was up a lot more before the Friday close when it closed. And then I looked at the S&P the last 15 minutes, and I could see why. Great week for growth stocks, as I'll show you. Last weekend, I was with a bunch of traders in Orange County. Any of you joined for this video, I appreciate you coming by. And it was a great meeting. Learned a lot from George and others, and hopefully some people learned something from me. I really entitled this A Resilient Market because that's kind of what it feels like. For every reason it should go down, it doesn't seem to want to go down. And I guess once we start to get complacent about it going down, and start to think it's different this time, it'll go down hard. Been around long enough to know that markets don't stay up forever. Disclaimer, this is for education purposes only. Any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm not affiliated with any software vendor or trading company. I paid for the tools that I use. Anything I recommend because I use it. I don't get any commissions or discounts because you buy something. Trading involves risk. You and you alone are solely responsible for any investment decisions you make. I like to think of my trading strategy as being my own, and that's why in the upper left-hand corner, I give you the same advice that I got from Ian Woodward, who's in the picture here, may rest in peace. And that was, I'm not a guru. Hopefully I can help teach you, and you can learn yourself to be your own guru. And I had a lot of influences on my style. I started with Cancelim as taught by William O'Neill, improved upon by Morales and Catcher, taken to the computer with www.highgrowthstock.com by Ian Woodward, his partner Ron Brown. This is my buddy George Lee, who I shared the podium with this past weekend, also with Chris White of EdgeRater. And then I married, this was great. It helped me find stocks to fish from and some money management, position sizing. And then I sort of added steroids and adrenaline to it when I met John Person and purchased his indicators and much of his tutoring and teaching and mentoring, his books. And he's been a great asset to my training. He's become a friend as well. And then Van Tharp is the god of position size and money management. I recommend everything that I use, and I recommend the folks that are on these pictures. Now, you may ask, how can you recommend everything that you use when you've bought everything in the market? I don't use everything in the market. You'll see a lot of icons on my desk that you don't see during these presentations. That should probably tell you something. What do I need on my desert isle besides high-speed internet? As I said, I bought a number of programs, but what I need is TradeStation or Thinkorswim. Genesis is a lovely platform, not necessary for most swing and equity traders. From an analytic perspective, HGSI is what I use post-market, and with a short delay intramarket. EdgeRater has automated a lot of the things that I do, save me money and time. I do believe in seasonality, but as an adjunct, not as a primary methodology, and those are some of the websites that I find useful. Here's highgrowthstock.com. I pointed out for 2 reasons: free 30-day trial, no credit card required. Trust me, if you don't follow the next message, you will boot it up and then you'll never go back. You need to learn how to use it if you're going to download it. Investing strategies here are a series of videos that I've done, and Ron Brown. There's others as well. And if you do download highgrowthstock.com and you want some dated but relatively specific training, I can give you a link to some videos I did that go through each of the different buttons, how I use them, and how I make money with the program. Now, stock patterns are cyclical, and as always, we got to know where we are. And by a resilient market, every time I think we're rolling over here, we keep going higher. And it's been this way for several years. We get to the top, and just as we think that the correction's coming, we get 2 or 3%. the sky is falling, the pundits are saying a crash is imminent, and then we take another leg up. And that's exactly what happened this past week. I think if you had polled the audience last weekend, that would have been predictions that this would have been a tougher week. Certainly with the failure of Trump's health care bill to pass, one might have thought that that would have been a sign for the market to roll over. But I think he played it pretty well, despite what you think of him politically, by coming out on Thursday and delinking health care from tax reform and stimulus. So you have to know where you are in the market, in the industry group, in the stock. And the way I make the most money is finding a stock market that's in stage 2, an industry group that's in stage 2, and a stock that's entering stage 2, where I have the wind at my back, so to speak, of both the market and the industry rotation. So based upon where I think I am, I approach the market differently. I do think we're up near this topping stage, but as I'll say later, topping is a process, not an event. And it seems to take a lot longer to happen with potential missed opportunities. So I do have a fairly substantial long positioning. I have taken off a lot of my hedges, which means the market will go down big this week, but I'm ready to put them on the minute I think the market is rolling over. But I do have less positions than normal. I've raised cash, and I've also started selling premium way out of the money, both puts and calls, to give me a cushion in case this market moves against me and generate some free profit dollars. As I think this market is rolling over, my strategy will change, and I'll take a much more aggressive to the downside and less perhaps defensive posture. First thing is, Friday was an interesting day. I already mentioned the sell-off end of day. And at least in the spiders, I didn't look everywhere, but I'm sure it's the same each place. And that was interesting. I don't know if it was some type of position setting for end of month, but I guess if I was up major and I had to close it for it to count, I may have closed it at the end of the month. What I'm more interested in is what happens at the beginning of April, which is this week. Typically, the market does better the first week of the month than it does the last, or at least from a volatility perspective. So we'll see what happens. Clearly, financials very weak, have been weak. I'll talk about that later. Friday was a weak day. I'm sort of scratching my head how I made money. And I know how I made money. My biggest position, share-wise and dollar-wise, is Amazon. And Amazon was up 10 bucks a share. So even with the market selling off, a 1% move in Amazon was very useful to me. You could see utilities showed some strength, as did biotech, selectively strong. Casinos strong. Some data came out about Macau. Revenue was up. As I did my weekend review, a lot of domestic casinos look good. REITs might be strong if banks are not, because REITs and utilities are interest rate sensitive. And home builders, not a great day on Friday, but on the week and on the last couple of weeks, home builders have been strong. When I look at the major markets on a daily, this is usually the chart I use to convince myself to be bullish. This blue arrow is a person's buy signal. This is, now I'm using ETFs since the Russell futures are no longer available for free on Thinkorswim. And then I've got the spiders, I got the Qs, I got the diamonds, and I've got the IWM. And you could see on the first three, we're clearly uptrend, 17 above the 50, above the 200. Stocks either just below or above the 17, all three in a PPS buy signal. Last time I checked, that was bullish. On the Russell, actually went to a buy signal on Wednesday and moved up above its moving averages. The 17 still below the 50. Interestingly, we had a big sell-off on Monday. As you could see, we opened lower, but actually turned out to be a fairly decent day. And you can see here the Russell had a big move from the bottom of the day on Monday until week's end, where it gave a doji. The VIX bumped up on Monday, failed at the 200 once again, and dropped down. It's not at the low as it goes, but you know, every time you get a spike, you wonder if this is the time the market's going to roll over. The fact that it can't break above the 200 is a good thing for the bulls for now. And then the dollar has been in a gentle drop, closing below the 50 a couple weeks back and struggling to get above it now. That to me is an important line in the sand. If the dollar fails at the 50 and goes back down to the 200, then I know that that favors certain types of stocks, including the small stocks. If I look at a weekly of the same thing, still it feels pretty bullish with some orderly pullbacks to the 17-week moving average on really all the indices. And again, the VIX and the dollar week, but on the weekly, the dollar you can see bouncing here off the 50 weekly. Not to kill you with index charts showing you the same thing, but I also like to look at this, which is in Genesis. The first stack is E-mini, then NQs, then TFs, then New York NYSE, and then IWM. Except for the NYSE, it's all futures. And you could see on the daily, everything is in a buy, including the NYSE, where it's sort of hidden right there. On the weekly, the only thing that's in a sell are the Russell and the Dow and the NYSE. So the E-minis and NASDAQ still look strong. The NASDAQ 100 being the strongest out there. Everything's still at a monthly buy. So certainly weakening, but hard to say that this is a bearish market. As I said, a market topping is a process, and you could look at certainly here on the Russell lower lows and lower highs. Same thing on the NYSE, same thing on the Dow futures, not yet on the NASDAQ, and I could probably make a case that it's occurring on the E-mini. So certainly evidence that the trend is no longer in your favor, and you could see some pretty ugly candles here on the weekly E-mini. All right. Now, a little background about some of the things that are going in the market. Both the 10-year and 30-year interest rates are stable. The line there is at 2.5% and then 3%. And I've sort of felt that interest rates won't be much of a headwind for the market unless they break above that 3%. They can't even stay below 2.5%. So, think about it. The Fed is tightening. We know we got at least another 50 basis points before the year is over and 2 25 basis point cuts. We hear with the EU things are doing well, and they're thinking about reducing some of their easing, which might be the first step towards tightening. We have a employment and economy that are humming, yet interest rates are falling. Something's missing. Again, falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. I saw that on my chart review this weekend. Didn't see a lot of banks pop up, or regionals, or insurers. So they are weak in a setting of a low rate environment. Looking at the AD lines, they both started to turn back up this week on the large and the small stocks. So no real big divergences there. I might look for AD lines to diverge and lead before the indexes fall. Breadth remains strong but not overbought. You can see on the green dot is a percentage of stocks above the 200 and above the 40, both in the middle of the range but not at an extreme. So there's still room for this thing to go higher. Now the 3-month new high, new low, which is usually what kills short-term rallies, when it peaks, it's moved up considerably, but you could have several very big days in the market before you take out the high. So getting more concerning, more overheated, but not necessarily predicting a fall on Monday. And now the McClellan has entered the fray, where the oscillator is now crossed into positive territory. And one could argue that although you have lower highs, you got higher lows, and perhaps there isn't as much a divergence on the summation index as before. This is the daily, the weekly, and clearly you have lower lows on the weekly and you've crossed above. So even less bad for the McClellan. So put it all together, this market is not showing me signs that it's done. We all know from a geopolitical perspective, the market could roll over at any time. From a timing perspective, it could roll over at any time. But it's not going to roll over because it's gone too far. If you look at the buckets, you can see 60% of the stocks in the S&P 1500 are above the midline in their Bollinger Bands. That's bullish, but not overly bullish. And you've got about 7% of the stocks above their upper band and just 1% below the lower band. Again, bullish, but not excessively so. The Hindenburg is a signal that I'll be looking closely for sign of a clear-cut top. I've shown it multiple times on these videos in 2007 and 2008. We haven't had more than a spurious one pretty much since then. They are a sign of a market top. There has not been a major correction in 5 decades or more that wasn't preceded by at least one Hindenburg. Most Hindenburgs fail, about 25% are meaningful, and typically it's more than a spurious one like we had in December. Or November, December. Interestingly, 3 out of the 4 characteristics 2 weeks ago were popping up, but we never reverted to all 4. And a little bit pregnant, still pregnant, but a little bit of a Hindenburg doesn't count. You need all 4 to make the diagnosis. Just sound like an ex-doctor. Diagnosis. Market tone. My diagnosis there is it's turned up some. It's still not great. That would be the 3rd column down, and if I remember correctly, it's is it XL? Yeah, it's you've got 2 indexes that are in the red, the rest are in yellow. This is improved. Over here shows the daily movement in the major indexes, and what it takes is a series of kahunas, blue kahunas to the upside to switch us to a buy market, to the downside in red to switch us to a sell market. We're back into a choppy market right now until the market decides to go one way or the other. And from and that's not a C, let's change that to a V so it makes sense. From a sector perspective, staples and healthcare are lagging. The rest are yellow, and that's clearly improved versus a week ago. One thing that Ian taught us about a couple years ago was to make a list of market-leading stocks, and then hopefully they'll give you a clue as to what's going to happen in the major market and get you out before. Now, one of the reasons why last week I was not totally concerned when I presented at the group in Orange County was that the Canaries, if I back down 5 days, were sitting right at a 17-day moving average with the 8-day just overhead in a squeeze, and it was pretty clear that they were primed to move. With all the pocket pivots, I thought they would go to the upside, and they did. So we're at an all-time high in the Canaries. Again, do I expect the market to roll over the next day after hitting an all-time high in the Canaries? No. Know your news and earnings per share. So as I look at this is from Bloomberg Economic Calendar. We see some Fed heads speaking. Manufacturing stuff on Monday. We have vehicle sales start to show up in a number of rags about debt on the cars may be a problem, and total sales have gapped down or fallen some. Factory orders on Tuesday. Wednesday, we have the ADP employment, which should be a big deal. PMI, FOMC minutes from last month. Thursday, a lot of news, but the jobless claims at 8:30 will be a big deal. And on Friday, again, monthly unemployment report, as well as the Baker Hughes rig count. Here's a list of some of the major earnings this coming week. It is not inclusive of all. And as I say below, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. Topping is a process. Bottoms are an event. We're closer to a top than a bottom. I have often lost money when I tried to hit the exact top and bottoms, so I will wait until the market gives a clear signal. There's still time for some caution. It is still time for some caution, but markets keep going higher. Breadth is actually increasing by multiple measures after a hard sell-off on Monday morning after the disappointment over failed healthcare. I'm still struggling with why interest rates are not rising, considering the Fed is tightening, confidence is high, and the economy is strong. Something smells fishy. And without fear of higher rates, look for continued improvement in bonds, REITs, MLPs, and home builders should continue to march. If rates remain low and the sentiment around rates rising remains low, look for weakness in banks and insurers. Typical top-down agenda, and now on to the charts. One of the things I did wanted to show you was just what last week looked like. Now, within HGSI, there's this great tool. And before I show you what this meant to me, in the tool, it's called the Group Inclusion Report, or the GPA rather, Group Performance Analysis. I can pick any group, so I chose all my different groups that I put together for April 2nd, the various different types of buy lists, and so on and so forth. And I'm able to run it and say between certain dates, tell me what the performance was. And if I go and look at this Excel spreadsheet, I took all my favorite groups. I said if I bought them at the close of the day on Friday, so what they closed at, sold them at the close of the day this Friday, what was my performance? Now, some of the major ETFs, you can see that the Russell 2000 was probably the best of the indices, was up 2.22%. Silver was up 2.62%. So it was a good week for commodities, up 2.7%. Oil and gas were up big. And if I go down here to the red, the VIX, despite its spike, was down considerably. China was down. Utilities were down. The bonds were down a bit, but if rates stay low, bonds are probably going to strengthen. And surprisingly, gold did not do much, although silver did. The S&P 500, at least on this analysis, was up 0.8. Over on the left are a number of the groups that I put together to look at. And so here's the S&P 500 at 0.8. And I always like to know how growth stocks did compared to the S&P. And I could see the Market Smith 250, the HGS 100 were both up 1.2%, so 50% higher than the S&P. The IBD 50, which is a smaller list, was up almost double the S&P. My buy watch, interestingly, half were good, half were bad, but the average was up 1.23%. Obviously, my buy watch is done on the weekend to get a list of things to buy if they break out. And my pullbacks, just a smart group from HGSI, were up 1.34%. You can see the stocks that I owned were up better than my buy watch list at 2.17. What was weird was stocks and groups to the downside up 4.8. Negative earnings growth up 3.48. Potential short sale stocks, and these are all smart groups from HGSI, 3.0. Stocks and groups to the downside minus 2.62. So it was a week, well, I guess this is the right bucket, turnaround stocks. It's a week that favored stocks that were doing poor the prior week. It's interesting, but what most important to me, here's S&P and here's growth. Growth is outperforming, which is good because based upon what I just showed you, you should probably accept the fact that I'm a growth stock investor. Hence, the outperformance. That means when the market rolls over, if I'm not careful, my beta is pretty high and I will outperform to the downside if I don't change how I do things. And hence why you'll hear me often talk about getting defensive. I want to run, but I don't want to get run over. Next thing I like to do is jump into TradeStation very quickly. And I mean, it's actually funny because I do this 5-point analysis in 3 time frames on the major indexes. And so many people have actually reached out to me and asked, how do I get the indicator so they can do the same thing? 5 points. Number 1, is it in a buy or sell by John Person? Those are the arrows. I think it's self-explanatory which is a buy and which is a sell. I think it really is designed to be a trend change indicator. Well, I want to buy up trends and sell down trends. Second thing I look at is the color of the paint bar. That comes from Alexander Elder. Green is bullish. I can go long or hold. I shouldn't be taking new short positions. Red is bearish. I should be short or hold. I should not be entering new long positions. And blue is neutral. Doesn't give me a signal. Third thing I look for is that auto envelope. And I know that although we can ride up the envelope for a long time, when I come outside of it, I usually come back in pretty quickly within a couple of bars. The fourth thing is I'm looking at, are there any paint bars, little dots above price? If they're above price, that tells me there's evidence of potential bearish divergence. If they're underneath price, it's bullish divergence, or as John corrects me, convergence. Fifth thing I look at for is my high jump indicator. This is a analytic method is taught by Ian Woodward. I'm measuring the dollar distance between price and 3 moving averages, adding that number together and looking back over the past year and deciding how close am I to the most extended I've been, and that will be here. So let's start with the now let's go. All right, we'll use let's use the futures. First thing I want to do is take the E-minis and drop them down to a 1 minute chart. And hopefully, is that going to work? Try this again. 1 minute. Let's see if I can go far enough. That might be too far. All right, it's not giving me enough, so let's make it 5 minutes. And if I go back to, here was 345, and this bar got as high as in the neighborhood of 23.66, 23.61. Here is 4 o'clock, and this bar went from 23.61, was only down 1. That doesn't make sense. And then, yeah, 23.66. I think this was this bar here, the high of that bar. Hold on. Oh, okay, it's not giving that bar. That's why it does. Yeah, the high of this bar here was about 23.66. We had 5 S&P points taken out. By the time I got right after the market closed, we're down at 23.58. So we were down 8 S&P points. Not a big percent, but that was sort of a whoosh out of the market. And I noticed that my gains, some of them evaporated in that last hour of the day. So again, I don't know if that was something to do with positioning for the end of the month or something more ominous. Maybe there was a fund that needed to raise some cash. Don't really know the answer, but I was waiting for the futures to open up, and they've opened up kind of flat. So hopefully it's not something that's going to continue. I'm back on daily. So E-mini dailies. 1 point on the buy signal from person. 2 is the paint bar. 3, there's no envelope issue. 4 plus, there's no dots. And 5 plus, it's below 90%. It's at 70% on the high jump. Very bullish on the short term. On the weekly, not so much. You got blue, you got MACD divergence, you got a down signal. And on the longer term, monthly is strong, green and an up arrow. So you could feel very bullish about the daily. I think there's some headwind on the weekly. So I'm going to give it a bullish but not overly bullish appearance. Now let's go to the YMs. And you'll notice there's some subtle differences in the calculations in the various programs. So you can have some buy-sell differences between TradeStation, Thinkorswim, and Genesis. So the YM, it's a +1 on an arrow. It's neutral on the paint bar. It's not on the envelope. There's no dots. It's at 55. So again, bullish, but a little bit less so because of the blue paint bar. And like the E-minis, you've got downs bar, blue, divergence, stronger on the weekly. So again, bullish, but not overly bullish. That was let's go look at the NASDAQ 100s. Strongest of the bunch, buy signal in green, couple of dojis in a row, that sort of indecision building there. It's at 83% there. There's no issues with envelopes or dots. But again, weekly blue and dots, still in a buy signal weekly and monthly. So stronger than the other two, some damage on the weekly to be aware of. And if I look at the Russell, TradeStation, because they still give it to me, you can see it had a big move up. 1, 2, 3, 4, 5, 6, 7, 8, 9. This may have been the weakest index. It had 9 up days in a row. Or at least 9 days that appear to be going in an uptrend. Some, I'm not sure that each day was a positive day. It's not the typical candle pattern. Bottom line is arrow up, green paint bar, no envelope, no dots, 50%. So very nice on the daily, but like the especially the E-minis, in a sell signal on the weekly, buy on the monthly. Interestingly, unlike the E-minis, you don't have the dots and it's green. So I'd rank in order that the NASDAQ's the strongest, Russell looks second, and I put the Dow and the S&P sort of at a tie, but everything is on the bullish side. I look at the dollar and not as strong. The dollar is in a weekly downtrend, monthly uptrend. You know, here's those green convergence dots, which would suggest that we have a divergence here, and maybe the dollar is going to go higher. Sitting right on the 50-day moving average. Green. Yeah, this is funny. Like, we have a bracket at work, and so I get this thing that I'm in the top 100 percentile, which means I thought that would be good, except I'm in 500 and 730th place, which is the top percentile. We'll see who wins. I still don't think I have a chance because everybody got destroyed in the middle, but I do have Carolina and Gonzaga left. So back to the dollar. Short term, looks like it's rebounding against weekly headwind, and monthly it's sort of going sideways, but in a buy signal. So dollar improving, but I'm still concerned about the weekly headwinds. If I look at the VIX, we can see the VIX spike. You see it got above the envelope and right back down. VIX in a sell signal, but with a green bar. I think the VIX goes higher over the next couple of weeks. I think volatility is going to come into the market, and I think the indexes are going to have some more negativity. But I'm only a retired doc. I'm not a genie, and I have to play the market that I have. And right now, the market's still pointing bullish. But boy, am I ready to turn the corner and change if I have to. If I look at yellow gold is in a daily sell signal, although blue here mitigates some of that. Weekly buy signal with blue and a monthly sell signal. You know, you go back to 2012 when the gold got close to 2,000. It's just been in a horrible down move, and really until we get probably above 1,450, 1,475, we're still in this junky trading range on the monthly. So my journey through the market should have told you that still some bullish sentiment here, but concerns are growing. But there's no question short term the market's had a bit of a bounce. Now I'm going to go and look at my HGSI, and I'm going to open up the warehouse view. I'm going to go in group database. One of the things you get are Woodward and Brown groups. I'm going to go into Major Markets Plus, and I've got to put a view in, which is a combination of a filter that limits what's on the list and a combo ranker, which ranks them to something that doesn't require volume, because not all the indexes have volume. So use the top down. This looks at momentum 1 day versus 5 day versus 3 weeks. And you could see that over the period of time that we looked at, especially short term, small and mid cap stocks and NASDAQ outperforming S&P 100, 500, NYSE in volatility. So that's why growth is working. Small and mid caps are working. If I take a look at some of the favorite things just a little differently than last time, let's go into my cleaner view here. So what we're looking at here on the top are the weekly bongo is basically my buy sell indicator. I was part of the development team, and I know that in most times of the market's going to turn lower, maybe a week late, but that will go red, and that will make me concerned. The weekly bongo is just below it. A weekly bongo, a daily bongo is just below it. The weekly bongo is a long-term trend. The daily bongo is a short-term, so if I get a pullback, as we had here, the short-term will go red. The next two are just two different measurements of the Hindenburg, and just for grins, if I go back, you'll know when you got one, because you'll be sitting there thinking the market's just dandy, and you're going to look up on your chart and you're going to see as you're moving up, all these red bars are setting. That was an alert that we're about to have a correction. And if we go from top to bottom, when we finally got that correction, top to bottom was, give or take, 8% in 27 days. That's a pretty big hit. And if you got a growth stock portfolio, it's been down 15%. Now, do I get out the first dot? Absolutely not. I could have gotten out when I broke below the 50. Could have gotten out when my weekly bongo went red. I could have gotten out when I had a high closed doji, a low closed doji right here. So there are several reasons why I would have gotten out, but getting out late would have still been okay if I'd gotten out when I broke through the 50. Now, that was in 2006. I was in Paris during that one. Didn't know what a Hindenburg was, or I should have known, but I didn't. But then everything was fine, and the market recovered. Market's doing great. We're now early 2007, and we had a little bit of a fall here, but the market caught its breath, and so about 6 weeks back to normal. Doing fine, and then all of a sudden you get this volatility. This was nice and tight, and then we get a bunch of volatility. We start to fire Hindenburgs, and again, was it the weekly bongo that went red? Was it the break decisively below the 50 and the failure pick? Was it the 17 rolling over the 50? There were a number of things that should have gotten a person out of the market, and if that one didn't teach you, the market ultimately did recover. It's going to be a very forgiving thing, and then boom, 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 a series of Hindenburgs in late of 2007, and again, if you had gotten out at the break of the 50, you would have avoided quite a drop in the market. I got to take my dog out. I'll be right back. All right, I'm back. Sorry about that. My dog has a little tummy ache today, so when he whimpers, I know I have to run him outside quickly. Just what you needed to hear. All right, so I got the S&P 500. Let's get back to current era, and you could see that, yes, we had two Hindys occur here. And, you know, this one was in the midst of a pullback that ended the next day. This one was at a top. They pulled back a little bit, but a single Hindi by itself I don't get too excited by, and a month apart I don't get that excited. All right, so let's just talk a little bit about the S&P here. You certainly can make the argument and draw the picture that we had a high, it had higher highs, or lower highs rather, and lower lows, and that if you want to buy that we're no longer in an uptrend, I think you can make that argument. So that would be the bearish argument. The bullish argument is we pulled right down to 50, and now we're bouncing and we're going to go higher, and which is why last week, you know, it was a tough call. We certainly had a bearish looking combination here, but we pulled right back to the 50, and the rest was history. So hard for me to look at this and be real bearish, although I am concerned that we are in a downtrend now, but we'll see. Time will tell us. You know, if we take out the prior highs here, then we're back in a bullish marketplace. Until then, I guess we're sort of range bound. Let's see where we go. Certainly not overly bullish nor overly bearish. Let's take a look at the Dow. One of the weaker performers on the week. Kind of looks exactly like the S&P, doesn't it? I mean, same sort of a picture. Are we in a new downtrend with lower lows and lower highs? Remains to be seen. If I look at the NASDAQ, look a little bit different. NASDAQ continues to move up. Let's kill all these things. And just below all-time closing highs. Well, actually that was an opening high. Pretty much at all-time closing highs, a little bit below all-time highs. NASDAQ does not have the picture of lower highs and lower lows. So NASDAQ is not confirming. And then we get to the Russell, which, as I said, is probably the strongest over the last period of time. 1, 2, 3, 4, 5. Yeah, it really was 7 up days in a row, and the 8th day being a doji that closed at the top. Notice the bongo is red on the Russell on the weekly, so that suggests it's been a little bit deeper of a pullback. The others are all still green. But the Russells had a big move. I mean, off the bottom from the low of the day to the high of the day on Friday, Russells had a 4% move back up. So the Russell's getting back into, you know, maybe I can just say Russell's into some area of congestion here until proven otherwise. But I would no longer say that the Russell is the weakest. In fact, the Russell, as I said, probably is in second place behind the NASDAQ. So, got one major index with the bongos in a bearish formation. I have concern about the market, but I don't think it's over yet. As I said, it's a resilient market. I need more clues before I'm willing to bail. On the dollar, but let me tell you, I am ready to bail the minute I get those clues, and I'll probably continue to let go of positions this week unless the market breaks out of where it's at and moves to higher ground quickly. The dollar has been in a downfall since the beginning of the year, so we have a counter trend rally up to the 50. If it breaks through the 50, I'll have to pay more attention to the dollar. The VIX, as I said, it had a volatility spike this week and came right back down. It's not as low as it can get, but it's still what's historically pretty low. But notice the bond goes green on the weekly, suggesting that maybe it's going to go higher. That won't be good for the longs. Gold, dollar strong. You know what that means about gold. You know, gold failed here at the 50. According to David Elliott's work, that's a nice whole, this is the 200 there. It failed at the 200. It's going to go down here and drop below the 50. It did that. It failed again at the 200. Until the gold breaks decisively. What's decisive? It breaks up, and the next day it tests or closes above the moving average. That's what's decisive. Until it breaks above and stays above, I'm not touching gold to the long side. And silver, a little bit stronger as we saw. It's above the 200. If gold looked like this, they had the green weekly bongo, I might be a little bit more optimistic. The problem with gold, it failed twice so far at that 200, which was support on the way down and resistance on the way up. So that's my take on the major markets. Those who've been here before, the next thing I do is go to Major Markets Plus 07, which is the industry groups. The T1 is price and volume momentum over 3 time frames. I don't care about momentum 3 weeks ago. I care about momentum the last 2 days. So 2-day force is giving me price and volume plotted, price times volume plotted, the 2-day exponential moving average. This is the number. The higher, the better. So 2-day force is ranking short-term momentum. I see that 67 of my 170 groups are to the upside, while only 13 are to the downside. That's a strong market. Some of the things that we like, banks are weak. I said why? Because of interest rates. Interestingly, home building, although up 2.43% on the week, was down a little bit on Friday. Steel raw materials like Techminco and Vale are weak, yet producers are still pretty high. Freight, which carries energy, down, yet energy will be near the top. Automobiles, internet media to the downside. But let's look at what's moving up, and let's show you how I take top down. As I said before, the way I make the most money is I find the market that's strong. We're not in a strong market, but it's still bullish. I find the industry groups that are leading in this market today, and then I try and find the leaders in those groups and jump in on them. So one thing that just struck me as being interesting, unusual, and sort of indicative of this market is that this is not a high ERG driven market. ERG EPS rank. Well, you know, there's no green here. I mean, I could go up here and show you where there are green earnings per share rank somewhere. Maybe they're in the downside. Let's take a look at that. Well, there's one. Well, no, I guess the high earnings per share, they must be. They got to be somewhere, so let's just go to a scorecard combo. It's not going to show that. All right. Maybe EPS rank. That should work. Let me figure out what I need to do here. Scorecard combo, no filter. All right, let's make this. I got it. Next equals yes. Okay. And let's do by EPS rank. And we could see that there's only 1, 2, 3, 4, 5, because you know, industry groups that are green. And if you think about it, it should be. Let's see, there's a 170. That's only. That's a very small number to be green. We have quite a few that are red. So earnings per share rank doesn't seem to be very meaningful when it comes to what's working now, or else all these would have good earnings per share rank. Let's go by combo. Relative strength, well, also doesn't matter. That semiconductors have the best relative strength, and they've certainly been great performers of late, and they are in the top, some 13 groups, and even group rank, that might be the most important, that some of the leading groups have the highest group strength. That's probably a self-fulfilling prophecy. I guess the point of this babbling is this is not being driven by high earnings per share and relative strength. Take a look at exploration and production. Up 6% over the last 5 days, 1.5% the last 1 day, the best momentum right now. And we'll look at the top, I only look and buy things above the index. So if I double click on ConocoPhillips, and let's move this to my typical webinar view, which adds a bunch of things. You probably don't want that view, do you? Let me turn off the VSA stuff. Hold on for a second. Let me just pause it. I'm back. Yeah, Ron Brown has really done a lot to help us learn VSA. And I have that incorporated in one of my other computers whom I copied over to this one. I don't want to clutter today. So here's ConocoPhillips. What do we see here? Everything is green up here except distribution, which is neutral. It had a Bible gap up on Friday. Earnings are not due until the end of this month. It makes money with great earnings per share growth. We're dropping $1.74 loss and replacing with 78 cents of a win. You know, if they make their number, this is a huge turnaround in earnings. If they hit, this is next quarter, the following quarter. Broke above the 50. I like that on a kahuna. I think ConocoPhillips looks interesting here. This is one you might want to consider. Chesapeake Energy, sort of the opposite story. It doesn't have a lot of earnings, but it's got good earnings percent. But the opposite story is it's still below the 200-day moving average. A break above the 200. This is one of the cheaper oil stocks. Certainly it's had some debt issues. 11% of it short. Chesapeake is the other. Everything, it's got a red weekly bongo. If I'm going to go energy, I'm going to look at ConocoPhillips. I had a couple others on my longer review that looked interesting that I'll show you later. Oil and gas services. Don't know anything about this one except it must have a lot of reverse splits. So when I looked at it in a different program, it's come down a lot. I can't buy this stock. It's way down. I don't know why it showed up on the list, except I guess it had 3.7 million shares and it moved 50 cents on Friday, and that's a big mover. That's typical volume day. Is that really met the average volume? Yep, 3.748, and the average is 3.769. I passed on this one, and if I went below the index, you know, if I want to play here, why not play here? I mean, why wouldn't you want to buy Halliburton? You don't want to buy Halliburton because it's in a very significant downtrend. You don't want to buy Halliburton because the bongos are red. You don't want to buy Halliburton because there's absolutely nothing on this chart that says to buy it, except it's sitting on top of the 200-day moving average. It's a low-risk buy point. It's still above the 200. The PSAR reversed. If energy increases, which remains to be seen, if energy increases, this might be a low-risk opportunity to buy a blue chip in the energy field. The other, let's just go through, see any of these look the same. RPC's already actually had a mobile breakout to the upside, stopping on the 200. Basic, that one's not even going to look at that one. Weatherford, Ensco. See if I can find Schlumberger, which is the other of the big boys. I like Halliburton better. Schlumberger's still got to get above the 200. I think if you want a low-risk energy play, and it's kind of perhaps boring, I guess you can go with Halliburton and ConocoPhillips. But right now, you know, energy has not been strong, but it's the top of the list. Semiconductor devices, talk about strong. You could buy almost any of these on the top part of this list, and several of them made my watch list, as you'll see. AMD, I'd rather wait till it gets to the 50, but it looks like it's turning back up. It had a mobile breakout from a squeeze on Thursday. Earnings are not out until the 20th. It had a kahuna on Friday. Everything is green. I think you can buy this right now. Almost 10% of the float is short, which means a lot of people are betting that it's going lower. And if their earnings continue to be good, their numbers beat, then this could be propelled by a short squeeze like AMD. Intel, kind of a boring name, isn't it? And kind of sort of a wedge over many months, but sitting right on the 50 with a kahuna in a squeeze, good earnings per share growth. I prefer the one I showed, AMD. XR is a buyout, I believe. NVIDIA, I'd like to see it show me some oomph and some momentum. It's not right now, but we'll keep an eye on that. Micron, another leader, gapped up on earnings, going sideways right now. It was a buyable gap up, so if you know buyable gap ups, you might know how to play that. HIMAX, some of the ones I like that are below there, I thought ON looked interesting here. Uptrend sideways to the 50 and a bounce, mobile breakouts from a squeeze, multiple kahunas, pocket pivots. This one has all the signs of wanting to go higher. Ian really emphasized that if I saw multiple days in a week, every other day in a week with a kahuna, that I should pay attention to it, and I am. I think ON Semiconductor looks interesting, as does MACOM Technology, MTSI. Similar pattern, multiple kahunas, mobile breakup from a squeeze, everything turned green and has earnings. So now you see why I said semiconductors look good. I could have gone further. I mean, look at Chemet. Don't know anything about the stock, not necessarily saying I buy it, but I mean, uptrend, sideways pullback, sitting on the 17, mobile breakout from a squeeze, a pocket pivot, and a kahuna, no earnings for a month. Great earnings per share growth. I think semiconductors have been, and until they're no longer, continue to be the place to be. REITs, I mentioned REITs look good, and part of it's probably interest rates. I think you're going to have to pay a lot of attention to where you want to go to REITs. Simon Property Group, if I remember correctly, is a shopping center owner. Had a dinner conversation with a retailing expert, and we talked about the demise of the big box stores and the shopping centers. He pointed out these things pay a great dividend, but eventually that may have to break. I'm not touching this. Why is it up? It's up because it had 2 million shares traded and moved $2. That's why it made the list. It's got earnings per share growth. I'm not interested. Equinix is another REIT. I think this is residential. Equinix is like Cone and others where they basically are technology housers. So nice uptrend, maybe even a cup and a handle and a breakout. Pocket pivot, problem is it's a $400 stock, and I don't know anybody that's going to be buying thousands of shares of this. It's a great place to play options. But Prologis, they have a lot of commercial real estate, warehouses, other offices, industrial properties. All right, so it's not the big box. New Green Bongo, mobile breakup from a squeeze and a pocket pivot, breaking above its moving averages. Good earnings per share growth, 3.4%. That's more compelling to me. American Tower, we should have bought this a few weeks ago, breaking out to new highs. Great earnings per share growth. They own a lot of the cell phone towers. One of the ones, here's MGM Growth Properties. I thought this one looked good. Not a lot of volume, less than 400 shares. Breaking out here, kahuna, pocket pivot, mobile breakout from a squeeze, and pays a 5.7. And one of my favorites has always been Cone, which is another one of these data warehouse centers. It's been sideways for a while, but paid a 3.3% dividend. It's got great earnings per share growth. Looks like it wants to go higher. So those were about dividends. Or what about communications? I guess it's all about BlackBerry. Who would have thought BlackBerry, the Bible gap up, mobile breakout, and a kahuna on Friday with earnings? Don't know anything about it. Obviously, they must have been strong. I have such a hard time buying this stock. I think I'd be a better trader if I could buy stocks without having to know the name of the company and what they did. Because I get in my head certain things like Alcatel and BlackBerry would be tough for me to buy. You can see it broke out of a channel there. Profit beats expectations on software push. What else in this group? Motorola Solutions, another old, not sexy name. Makes money, slow uptrend. Extreme Networks popped on buying Avgo's, some of their networking that they had to divest themselves. What a really beautiful move here. Buy it off the 50. It's pretty extended here. Hard for me to chase, although you could follow Bible gap up rules. Acacia is what happens when a low float IPO gets chased up and then shorts are gone, the stock falls. It's in a slow uptrend. I actually bought some off the bottom, but it's like dead money because even if I bought on the very bottom, I mean, it's up almost 20%, but it's not up hundreds of dollars. I mean, it's up a handful of dollars. I actually have an option position on it. So Acacia, good demand is the bottom in. It's got great earnings per share growth. All right, so this is being driven by BlackBerry's earnings. Midstreams, I mentioned that MLPs looked interesting. I'm not necessarily a fan of the first one. Not that it's bad. Kinder Morgan, indicative of the group, pretty much sideways from left to right with some momentum on the right-hand side. This is in a weekly bond go down. Mobile Breakout out of a squeeze. Pocket Pivot and Kahuna pays a 2.3% dividend. Williams Company, similar looking chart, but a lot tighter. Pays a 4.1%. Keep going. Cheniere, similar pattern, breaking above the 50 with a mobile break with a squeeze. Pocket Pivot and a Kahuna pays a no dividend, unfortunately. One OK, pullback to the 50, breakout on Friday, pays a 4.4% dividend. Target Resources 6.1, same pattern. ETE 5.8, same pattern. EPD, it's a little bit lower in the pattern, sitting on its 200, but pays a 5.9%. So the charts aren't going to be that attractive, but you have to like the dividends, especially if the market's going to start having some issues. I hit the wrong way. Don't want to do that. I want to right-click on Application Software Index. Evolent Health, I know they're in some discussions about buying WebMD. It's an interesting story. I somewhat compete against them. They're a population health company. And, chart, it's slow growth, sitting on top of the 200. Looks okay up top. Not that excited by it. Adobe, that's an exciting chart pattern, but it's too far extended for my taste. Look for pullbacks. HubSpot's kind of loose. Don't know that one. All right. So, I don't know if you've been paying attention, but I tell you, exploration and production and oil services would be nipping some good quality off the bottom, ConocoPhillips and Halliburton. Semiconductors, dealer's choice, REITs, I'd look at some of the non-retail shopping center REITs. MLPs, find some yield. Didn't like much in the application software. Banks, this is kind of interesting to see these here with interest rates not helping. Bank of America, JP Morgan, and Goldman Sachs. Boy, is that a base if I've ever seen a base, and it popped with a Bible gap up on Thursday. Kahuna's Pocket Pivots, don't know anything about it. Private Bancorp. Toronto Dominion, I don't know if that's the Bigelow J hook. I mean, these are at best sideways plays. Not sure why they're so exciting. So I'm not going to like any of those. Specialty Pharma. I've made money on some of these little ones. This is Akari. I have no insight, no edge. A Bible gap up on Friday, relatively cheap stock. So, of course, you right-click, go to Web, hit FinViz, and pop out the news, which said, dun, 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 dun. They probably fast-tracked one of its treatments. That just suggests that it has an earlier, it's a positive. That's all I'll say. Now, the interesting thing is it competes against Soliris, which is Alexion's drug in PNH. That drug gets $500,000 a year per patient for life. big opportunity. Small volume company, normal, look at this. Woo! Note to Bob Meager. Remember we talked about squeezes and looking for volume in a squeeze. Let's see what happens. We're going to look down here for volume. 32,000, nothing. A million, 500,000, 5.9. Oops, I'm showing you the wrong stock. Ignore that comment. Go back here. Put my candle here. All right. All right, so the first candlestick is 32,000, 6,000, 6,000, 8,000, 15,000. You want to be buying at 48,000, 21,000, 18,000, 4,000, 595,000. You tell me there's no insider trading when a stock whose average volume throughout this period of time is 20, 30,000, 3,000, 2,000, 700. No one gave a darn about this company. And the day before the news comes out, it trades 595,000. And then with the news, it trades 18 million. I've seen this pattern over and over and over again. Some of these burn out quickly, think of Plud. Some reset at a different level, think of Intercept Pharma. This might be a fun thing to play. Volume makes the world go round. And notice the day before you also had a kahuna. You probably could have gotten in at the open because there was a big gap up, but it would have shown up on your intraday charts. Now, why would anybody in this world be looking for a stock that trades 2,000 shares a day? I'm not, but I am looking. Bob's working on for me an indicator that's going to look for volume aberrations in a squeeze, looking for this very same play. Catalyst, this is what they often do. They run up and come right back down. Not interested. Cambrex is a more expensive stock, kind of in a box off the 200 here. Kahunas, pocket pivots, turning green. Makes money. They must have something coming in the market. I don't know about who they are or anything about them. That looks interesting. I'd like to see it get a little bit higher and clear the prior highs. This is where it usually reverses, and until it breaks above that, it's still going to reverse there. I played this one up. It's now doing, looks a lot like Intercept did, except this would have been 600 at the peak. Don't have any insight, and its run is probably over. Endo's been garbage forever from a tradable instrument, and I'm not sure why it's there. I'm not that interested. Let's see if I can find Esperon and tell you here. This is one that also had a great move up, and now it's come back to support, and I'm looking for Esperon to maybe go higher. So that first one, Akari, looks like an interesting day trader, short-term trader. And lastly, steel producers. You know, I have a fairly substantial position of U.S. Steel that I accumulated maybe 18 months ago when the stock was in $7, 2 years ago. Now it's about 16 months ago. And I've sold some along the way. I bought some back on pullbacks. I'd love to see it go higher. I don't see it right now. Not even, well, I guess it's up because of this day had a big day. It was up $1 on 16 million shares. So that's top-down investing. Another thing you could do is, and I'm not going to spend the time today, is look to the downside. And you can see if I right-clicked here, I'll see some of the weaker things come to the top, such as JP Morgan, Bank of America. I'm still bullish, intermediate and long-term on these, and one could make the equal and opposite argument that sitting on the 50, getting close to a buy point on these. But I'm not going to buy them until they show some momentum to the upside. I really like the fundamentals on Bank of America, but right now, not working. So what I've typically done on a nightly basis is just what I've shown you. There's another trick in HGSI called the group inclusion filter. In the group inclusion filter, I can go to Tools, Group Inclusion Report, and I can do both long and short. I clear, I load selection, and what it does, look at all the bullish groups that I've identified as bullish, and show me some of the top stocks that are occurring in them. I only care about the first say 15 stocks, make a group. We're going to call that webinar GEMS 4.02.2017. And I'm going to hit this button. It's going to take a few seconds. Just call it web. Yes. And it's going to show me which stocks are showing up in the most of the bullish lists. Amacor Technology, Chemet, I showed you that one. Builders FirstSource, here's another semiconductor. Exelixis, a small biotech. So these might be a bottoms-up approach of looking at what groups are most popular. If I'm bearish the market, which I'm getting increasingly, but that's not what I'm looking for today. I need to see more evidence. But if I wanted to see what might be some bearish plays, I could clear it, load selection, and look at short side. And it's going to give me a list of some stocks that I might want to consider to the dark side or to be watching them. Notice the healthcare stocks here, airlines, fertilizers, automobile. So these are some of the stocks. One of them, for example, GLW. I usually take this list and I'll open up maybe TradeStation, go into my advanced screener, look at my list of potential shorts. Let me get this. And I didn't put this one here because it's too cheap. I like to short more expensive stocks. But here's a stock that's had a big run up. It's had a reversal on the monthly. It's in a weekly sell with these red dots suggesting MACD divergence. Volume is heading down faster than price. Volume is cross below the moving average on the daily. I'm coming out of a squeeze with a mobile breakdown, a PSAR reversal to the downside, a negative kahuna, and a negative pocket pivot. And I had a red candle low on, a low close doji on Friday in a bearish setup. I think Corning would be one that I might want to short, and I first saw it by looking at that list. I do a bottoms-up list. In that bottoms-up list, I've accumulated lists throughout the week and over the weekend, and I basically throw all those lists into a giant watch list. That watch list is made up of certain smart groups, certain things I get out of IBD or MarketSmith, some of my favorite filters or scans that I've learned over the years, and I end up with a list that I then filter for price and volume, and it was found some malware. Isn't that exciting to see? It was 707 stocks. I looked at the 707. First thing, notice, and these are ranked by how good they look. Semiconductor, 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 I hope you got some semiconductors, because right now that's what's clearly working the best. And then I filter that down by looking at every one of them, and I ended up with my buy list. My buy list was pretty large this week. If we look at where they're coming from, I've got some cement and aggregates. Take a look at Cemex. Certainly not the leader in the field, but sitting on the 50 with a couple of kahunas and a mobile breakout from a squeeze. Doesn't have any help here on earnings per share growth. I thought that looked interesting. Martin Marietta's pulled back hard, had a big up day on Friday. Actually, has been trading up for 4 days after pulling down to the 200. Multiple kahunas, pocket pivots. MDU Resources sitting on the 50. Looks like it wants to break out. And Summit Materials. So I thought these looked like a wolf pack that was ready to run. And you could see there's quite a few of them. On the exploration phase, yes, ConocoPhillips looked good. I really want to get back into Diamondback. This is a Permian Basin driller. And look at the earnings per share growth to come into this stock. There's a reason why it's a $100 stock. Stick it on a weekly. You've been in a huge uptrend. You just pulled back to support. I'll be looking to get back into FANG. Others in the group, this was interesting too, Laredo. Most of these stocks are underneath the 50 and the 200. Here's a guy breaking above the 50. Everything is green, makes money, Laredo. And I believe this is another Permian Basin driller. Yep, Permian Basin. Don't know much about the different basins except the Permian's probably the place to be. Midstream oil and gas, I talked about in some case, the dividend play. And I think if I had to pick one, I'd probably buy one of the two E's, either ETE, breaking out here, dividend of 5.8%, or Enterprise EPD, a little bit further down with a 5.9% dividend. I like those, but quite a few. I mentioned some REITs. There's that Cyrus One. DuPont Fabros Technology is another one that looked interesting. That is in the, I think, technology storage, wholesale data centers. Pull back to the 50. Kahuna, Pocket Pivot, Mobile Breakout from a squeeze, great earnings per share growth, 4% dividend. If you were at my meeting, we call that a Jeffrey stock. There are others here I liked as well. Again, I'm shying away from the grocery store REITs. And then semiconductors, I think we probably looked at all of these. AMD, AAOI, Chemet, Maycom, ON, Amcor, several of these look good. I mentioned that Akari, and then missed this the last time, but American Waterworks looks like it's setting up to run up again. Sideways move, Mobile Breakout from a squeeze, everything's green. Pocket Pivot Kahuna pays a 1.9% dividend. So there are clearly a lot that I like. Just to give you an idea of what do I do next, once I get my buy watch list, I review them in TradeStation, actually a bigger list, and then I come up with some of my favorites. And these were some of them that really came to the top. And these all came out that larger list as well. Southwestern Energy also looked interesting. I'm not sure if they're Permian or not, but high close doji on the weekly, daily and uptrend, new buy signal on the daily, histogram turned positive, OBV went positive, weekly bongo went not yet positive. That was the only downside. So there's a lot to like. I think you got to be careful what not to like. I still don't like insurers. Here is Cigna rolling over. Last week at the meeting, I talked a lot about the impact on healthcare of the bill being turned down. Obamacare is great for, one, hospitals. People pay their bills because they all have insurance. Two, people that sell sick people anything, like medical device companies, drug companies, biotech. The asterisk on medical device companies, there was a small Obamacare tax placed on them, which I'm sure they passed through as a price increase. Who does poorly with Obamacare? Insurance companies and that tax on medical devices. So if Obamacare is staying, insurance companies aren't going to be happy. So what have we done so far? We looked at the top down. I spent a lot of time looking at the market because, hey, as the market goes, so does my portfolio. I helped identify using momentum what I think are the leading groups in the market right now. And I took you on a journey of some of the leading stocks. I showed you my bottoms-up review, pointed out some of my favorite stocks, and clearly pointed out some of what we refer to in HGSI world as wolf packs of some stocks that are going up with many of their friends. And I've always made most of my good money trading when I bought stocks in wolf packs. So we got some wolf packs for you. I think we got some winners in there. I think the biggest issue is, where I kicked this off and said topping is a process. In the top of the process, we're going to have some relative volatile weeks up and down. I'm going to be looking for Hindenburgs. Trade safe. I think right now trade smaller. Be careful. Have a great week, and I'll try and do this again next week. Appreciate and always enjoy hearing from people that have positive and negative criticism, and see you next time. Thanks, everybody, and good night.